Hi, and welcome to this edition of the Insurance Experts. It's really my pleasure to have on the line Kerry Peabody. Kerry and I know each other because we're both on the board of advisors for the LTCi organization, one of the premier training organizations. But I'm so pleasure to have him on the line today because he has a client story to share with us. But first of all, Kerry, why don't you tell us a little bit of your background? How did you get into the long-term care business?
Sure. First, thanks, Mark, for having me on. How did I get into long-term care? Utterly accidentally. I was in the Air Force, got out of the Air Force, stumbled into the long-term care industry. I was a medical underwriter for a while. I was a national sales director for Unum, and for the last 16 years, I've been in sales. I've built most of my business on referrals. I work primarily with fee-only planners who do comprehensive financial planning for their clients, but they don't sell insurance, so they need a resource for that, and that's how I market to them. I'm a resource for you. And attorneys.
Okay, very good. And I know you were telling me about a financial planner you were recently working with. Why don't you tell us a little bit about this planner?
Sure. Again, he's a CFP financial planner. He's grown his firm from one person to about 5 people over the last 10 years. He works with fairly affluent clients. And this client we're going to be talking about today that he sent to me was a surgeon who's on the verge of retiring.
And so why is he such a big proponent of adding long-term care to the financial plan?
Because he's an intelligent human being. He understands it. He gets the risk. He works with people who can self-insure, I suppose, or self-pay, but he understands the importance of using insurance for leverage.
Okay. So let's talk about this client. Why don't you tell us a little bit more about the client that you worked with this financial planner?
Very successful surgeon. He's been doing this for 30 plus years. He's owned a couple of different practices on his own, and he's been a hospital employee for a big part of that time. He's 62. His wife was 57 or 58, I believe, and he was getting pretty close to packing it in, and the planner brought up the topic of long-term care insurance.
I mean, what do you think the surgeon's reaction was when he heard about long-term care planning? Was he a proponent of it, or did he not really get it?
Well, these guys have got over $4 million in assets. I'm talking about investable assets, not total assets. So frankly, he didn't think it was necessary. He could just pay.
I see. And so what was that conversation like with him about why you thought he needed a plan?
Well, a couple of things. I mean, first, as you know, people tend to react to the talk of long-term care as, oh, well, we talk about nursing homes. I'm never going to go in a nursing home. Well, you buy long-term care insurance for 2 reasons. 1, to keep you out of the nursing home as long as humanly possible, and 2, to protect the assets for the healthy spouse. With a couple, I always focus on you've got to stay out of the nursing home and protect the healthy spouse. People don't understand how much long-term care services cost because they're always thinking about today. Yes, he can write a check today for $10,000 or $11,000 a month here in Maine to pay for a nursing home, but he's not going to need long-term care next week. He's going to need it 25 years from now when he's 87 years old, and it's going to be $20,000 a month. Mm-hmm. You have to point that stuff out and make them sort of absorb that.
Okay. And what part of this conversation do you think resonated with the surgeon the most, that he wanted to look at some of the different planning options?
Well, I think the first part was, we don't want you in the nursing home. We want you to stay at home, Chuck. His name's Chuck. And frankly, Chuck, long-term care services at home can cost 2 or 3 times what a nursing home costs. Even if you don't need skilled care, if you need somebody just standing in the room with you to make sure you don't get hurt 24 hours a day, 7 days a week at $35 or $40 an hour, that's going to add up really fast.
Right. So what was the solution that you were talking about designing for him?
So with all of my clients, I show them any product that I feel is appropriate, and frankly, I let them decide. I'll sort of nudge them one way or the other, but I'll let them make the decision. So with Chuck, we talked about standalone long-term care insurance, and we talked about a couple of the different hybrid plans.
I see. And which one of those ideas resonated with him the most?
He sort of liked the hybrids, but he liked the price more on the standalone long-term care plans, because even though he's wealthy, he's watching his dollars.
Okay. And so what type of standalone plan were you looking at designing for him?
Sure. We went with a plan that would cover $200 a day in any of the settings. It was going to be 3-year benefit periods each. We did shared care with a shared third pool, so they had another bucket of money there that they could both draw from. It had a 90-day elimination period and 3% compound inflation.
Okay. And what was the cost of the plan?
Well, he chose the 10-pay. He wanted to get this out of the way as part of his retirement cash flow planning, if you will. So they were going to pay about $12,000 a year for the next 10 years, and then they're done.
Okay, so it sounds like a lot of money, $120,000 for their long-term care plan, but what were the benefits worth to them?
Initially, because they had three buckets of money, they had about $216,000 each. So they had over $650,000 that they could use for long-term care the day they wrote that first check.
Oh, wow.
So
Okay.
yeah, and then when you take the inflation into account, when they're in their mid 80s, they'll have over $1 million of long-term care benefits there, and they've only paid $120,000.
So they're probably getting at least 10 times what they put into it if they needed all the benefits in full.
Yeah.
Well, how would that compare if they wanted to self-fund that plan? 120,000. What would that be if they needed the care?
Well, I'm not the investment guy. We let the planners do that. But if you take $120,000 and put it in the bank today and never touch it again, you're going to have to make what, 10, 11% to get to that bucket of money at age 85. It's a lot harder to do than the long-term care insurance is.
Yeah, I guess at today's low interest rates, even if you bought, a 30-year bond, that's earning 3-4% today, it's not going to grow that quickly. Maybe you'll have double what you put into it. So 10 times for protection, maybe double self-insuring with more flexibility around the funds in that case.
Yeah, exactly. Yep.
So it sounds like the financial value proposition is really what won over this particular client, would you say?
Yeah, I think so. Two things: educating them that we're not trying to put you in a nursing home; we're trying to keep you out of it. And two, look at how little all this protection is going to cost you comparatively.
Awesome. Well, I appreciate you being on the episode. I know you wrote an article about self-funding versus transferring the risk on LinkedIn, and I'll kind of pair that to this interview. But I'm sure I'll be interviewing you more in the future. Thanks for joining us to talk about this particular case.
Thanks, Mark. Nice talking to you. Take care.